Did you know that one single number accounts for nearly 30% of your entire credit score? It's not your income, and it's not how many cards you have. It's your debt-to-credit ratio. Understanding this metric is the key to mastering your financial health and unlocking the best interest rates. In this comprehensive guide, we are going to break down exactly what this ratio is, how to calculate it, and why it is so critical for your future. Simply put, your debt-to-credit ratio, also called credit utilization, is the percentage of your total available credit that you are actually using. Lenders use this to gauge how responsibly you manage revolving debt. A lower ratio suggests you aren't overextended, which makes you a lower risk. For FICO scores, amounts owed, which is mostly your utilization, is the second most important factor, right after payment history. Even VantageScore considers it highly influential. If you want a top-tier score, you cannot ignore this calculation. Before we calculate, we need to know what to include. This ratio only applies to revolving credit, not installment loans like your mortgage. You should include all your standard credit cards, retail store cards, and personal lines of credit in your tally. However, you exclude installment debt like car payments, student loans, or your primary mortgage, as these have fixed repayment terms. The fundamental formula is simple. Take your total revolving balances, divide by your total credit limits, and multiply by 100. First, let's look at the per-card ratio. Scoring models check individual cards to see if any are maxed out, which can hurt your score. For example, if you have a balance of $1,200 on a card with a $5,000 limit, you divide $1,200 by 5,000. This gives you 0.24. Multiply that by 100 and you have a 24% utilization rate for that specific card. Now, the most critical number, your aggregate ratio. This is the sum of all your revolving accounts combined. Imagine you have 3 cards with various balances and limits. We need to find the total for both columns. Adding up the balances gives us a total revolving debt of $4,000. This is our numerator. Adding the limits gives us $15,000 in total available credit. This is our denominator. Now we divide 4,000 by 15,000, which gives us approximately 0.266. In this case, your aggregate utilization is 26.7%. This is the number that matters most. So what's a good ratio? Most experts agree that you should keep your utilization below 30% to avoid score damage. However, the highest scorers, those with scores over 800, often maintain a ratio below 10%. Interestingly, a literal 0% can sometimes be less effective than a tiny balance, like 1%, which shows active management. Don't confuse this with your debt-to-income ratio. Your income is not on your credit report and doesn't affect your credit score. Debt-to-income is used primarily by mortgage lenders to see if you can afford monthly payments. Both are important, but they serve different purposes. If your ratio is high, here's a pro tip. Pay your balance before your statement closing date, not just before the due date. Another strategy is to request a credit limit increase. This increases your denominator, which automatically lowers your ratio. Use the debt snowball method to target cards with the highest utilization first, even if their total balance is small. And avoid closing old, unused cards. Closing them removes that credit limit from your total pool, causing your ratio to spike. Remember, credit scores are dynamic. Lowering your utilization can often result in a score increase within just 1 or 2 billing cycles. This makes it one of the fastest ways to improve your credit standing before applying for a major loan or mortgage. To recap, add up all revolving balances, add up all limits, divide the total balance by the total limit, and multiply by 100. Aim to stay below 30% across the board, and strive for under 10% for the very best results. Set up balance alerts on your banking apps. This helps you stay mindful of your spending before you hit that 30% threshold. Consistent monitoring is key. Your credit health is a marathon, not a sprint, but your utilization ratio is a powerful tool you can control today. By keeping this number low, you're signaling to lenders that you're a responsible borrower who can be trusted with more credit in the future. If you want to make this even easier, I've included a link to a specialized calculator tool in the video description below. Use it to check your own numbers today. Thanks for watching, and here's to your financial success.